Welcome to the Tell Me What I Need to Know series. This unit is designed to help solidify your understanding of the accounting cycle. As is the case with any challenging material, it's always a good idea to try to understand the big picture before delving into the details. The first thing to understand about the accounting cycle steps that you see here on this slide is that they are leftovers from the days when accounting systems were completely manual systems. As is typical in any manual system, an element of human error is present in manual accounting information systems, and as an attempt to minimize this error, several helpful procedures are woven into the process. One of these procedures is the use of a tool called the trial balance, and we'll look at how it works shortly. Nowadays, accounting software has made many of the steps you see here automatic or redundant. If you use Peachtree or QuickBooks, for example, the interface you see will obscure the accounting cycle I'm about to describe. So why do we still study the accounting cycle in today's accounting classes? Well, studying these steps is a way to establish a solid understanding of how accounting information in the form of source documents like invoices, checks, purchase orders, etc. ultimately impact the financial statements of a company. A clear understanding of the accounting cycle also helps us to be aware of how our actions impact what ultimately gets presented in the form of financial statements. The objective of the accounting cycle is to produce financial statements predominantly for external users. These statements are the balance sheet, income statement, statement of cash flows, and if shown separately, the statement of changes in owner's equity. Here are some important terms that you need to know before we proceed any further. An account is simply a record or list of activity for each element of the financial statements that we're interested in. Examples include cash, accounts receivable, accounts payable, inventory, equipment, patents, sales revenue, and retained earnings. Because of the nature of the accounting cycle, it's possible, theoretically at least, to check the result of activity to date in most of the accounts. A journal is a book of accounting events kept in chronological order, and in manual accounting information systems, journals are physical books. This is where business owners note each transaction as it occurs. Transaction information contained in the journal is later transferred to the individual accounts. Today, most journal entries are made electronically using keyboards, scanners, and other methods of recognition. This is because nowadays most accounting information systems are computerized. As a result, journals only exist in virtual form in these systems, though they can easily be printed on hard copy if required. Businesses always have one general journal, and they may also keep a number of special journals. More about this on the next slide. A ledger is a compilation of accounts used by businesses, and in manual accounting information systems is also a physical book. The general ledger is a compilation of general ledger accounts, and the subsidiary ledgers are compilations of the subsidiary ledger accounts. We'll talk a little more about this shortly. Nowadays, in computerized systems, ledgers also only exist in virtual format. Journals are often referred to as the books of original entry because in manual systems that's where business events are first entered into the accounting information system. At convenient intervals, the transaction information from the journals is transferred to the accounts in a process known as posting. Large businesses may keep more than one journal so that they can group similar transactions together in separate journals. An example of this arrangement is devoting one journal to cash receipts and using the general journal for everything else. Not surprisingly, these separate journals are called special journals. Special journals are useful because instead of transferring transactions one at a time to the ledgers, we can transfer daily transaction totals at the end of every day, for example. Thus, at the end of the day, we might post the day's cash sales total to the sales revenue general ledger account instead of posting each sale individually. This saves quite a lot of time in manual accounting information systems. This journal entry records the receipt of cash by a business in exchange for goods or services that it will deliver in the future, and is a common event for magazine publishers when customers pay in advance for magazines. The business records the cash it has received by debiting cash, and the corresponding credit is to a liability account called unearned revenue. Depending on the nature of the good or service that will be delivered, the credit will be to unearned sales revenue, unearned service revenue, or something like that. This journal entry records the payment of wages or salaries to employees. This journal entry records a credit sale of goods in a perpetual inventory system. The first part of the journal entry records the sale of the goods and is recorded at the sale price of the goods. Since the sale is on credit, the business does not receive cash from the customer, but instead receives a promise to pay, or IOU. We call these IOUs accounts receivable, and they are assets of the business. By debiting this asset accounts receivable, we record that accounts receivable have increased. The corresponding credit is to sales revenue, to record the revenue from the sale. In a periodic inventory system, this would be the only journal entry made at the time of the sale. Inventory would be adjusted at the end of the accounting cycle. In a perpetual inventory system, the second part of the journal entry is necessary to keep our inventory accounts perpetually up to date. The debit to cost of goods sold records the merchandise expense associated with the sale at the cost of the goods to the seller. The credit to inventory records the fact that the business now owns less inventory than it did before because it has just sold some. This final example journal entry illustrates the credit purchase of merchandise inventory for resale by a business. The debit to inventory records that inventory has increased and is necessary in a perpetual inventory system to keep the inventory accounts perpetually up to date. The corresponding credit is to an IOU account, this time showing that the business owes money to its supplier for this purchase. IOUs owed by businesses are called accounts payable, and accounts payable are liabilities of the business. If this had been a periodic inventory system, the debit would have been made to an account called purchases instead. As mentioned earlier, manual accounting information systems usually have two types of ledger accounts: general ledger control accounts, kept in the general ledger, and subsidiary ledger accounts, kept in the subsidiary ledgers. The general ledger control account balances equal the totals of their corresponding subsidiary account balances. For example, businesses need to keep track of how much they are owed by each of their credit customers. When a business records a journal entry reflecting a payment from a customer towards the customer's account balance, the business needs to post it to that specific customer's account. Similarly, when a customer makes a purchase on credit, it is important to post the information to that specific customer's account. These customer accounts are called subsidiary ledger accounts. The general ledger accounts receivable control account is simply the sum of the individual customer's subsidiary ledger accounts. Similar arrangements exist for accounts payable, the amounts we owe to our creditors, inventory, our assets held for resale, and any other account where it is operationally necessary to keep a separate record of the details within a general ledger control account. Posting is the process of transferring details of transactions from the journal or journals to the ledger accounts. We post to subsidiary ledgers, for example accounts receivable and accounts payable, one transaction at a time, to preserve the details of our credit customers' activities and our purchases and payments to our creditors. We post totals, on the other hand, from the special journals to the general ledger because we don't need to preserve the individual details. For example, we can post our total sales on credit to our general ledger sales revenue account and total cash receipts from sales to our general ledger sales revenue account. These two postings are much quicker than posting each sale transaction separately. Because we are effectively not posting both sides of each journal entry at precisely the same time, there may be temporary imbalances between debits and credits. This is just a procedural phenomenon though, and once we have finished posting, our debits should once again equal our credits, and our subsidiary ledger balances will equal our general ledger balances. Posting, of course, occurs automatically in computerized accounting information systems. First, a note about double entry accounting. Double entry accounting simply means that each journal entry affects at least two accounts. This slide shows two journal entries. First, notice that debits are grouped together first and indented to the left. Second, notice that credits are grouped together last and are indented to the right. Use this form in all of your accounting classes as it makes the journal entries easier to recognize and read. In the first case, we have a credit to cash showing a cash outlay, and the second part of the journal entry shows us what the outlay was for. In this case, the debit to inventory tells us that the cash outlay was made to purchase inventory. In the second case, we have the same debit to inventory showing its purchase, but this time we have credits to cash and accounts payable. This tells us that part of our purchase was made with cash and part on credit. By using the double entry format, we guard against forgetting to record part of the transaction. Since our debit entries must always equal our credit entries, even at the individual journal entry stage, it's quite easy to see if we have omitted any important facts. Trial balances are tools used in manual accounting information systems to help us periodically verify that the total of our debit entries to our accounts equals the total of our credit entries. By listing our debit account balances in a column to the left and our credit account balances in a column to the right and totaling each column, it's relatively easy to check that they are equal, or should I say, they balance. This evidence tells us important but limited information. It tells us that debits equal credits and no more. If we have posted to the wrong account, as long as we correctly posted as a debit or credit, a trial balance will not expose this mistake. Similarly, if we omit to post a transaction completely, our debits and credits will still balance, and a trial balance will not expose this mistake either. Trial balances are redundant operational steps nowadays in computerized accounting systems, usually because computerized accounting packages are designed to prevent our transactions from being out of balance. Nevertheless, trial balances are still an important teaching tool because they help to reinforce the notion of debit and credit equality. Trial balances only exist in virtual form in computerized accounting systems, but they can easily be printed out or displayed on a screen, which can be useful for examining account balances at a particular point in time. Because Generally Accepted Accounting Principles, or GAAP, requires us to use accrual accounting, the need to make adjusting journal entries arises. You may recall that accrual accounting means that we recognize revenues when realized or realizable and earned, and we match expenses to the revenues that they help to produce. Sometimes, though, we receive cash before performing our revenue earning activities, and sometimes we receive it afterwards. Similarly, we sometimes pay expenses in advance, and sometimes we incur expenses before we pay for them. In accounting terms, this means that we sometimes accrue revenues and expenses, and sometimes experience deferred revenues and expenses. A simple way to memorize the meaning of accruals and deferrals is that accrual events involve action first and dollars later, whereas deferral events involve dollars first and action later. It is these accrual and deferral events that cause the need for adjusting journal entries. This slide shows some ways in which accrued revenues occur. Notice that all these examples illustrate situations in which the revenue earning process is complete but the cash is not yet received. It's quite possible that these revenue items will